Welcome to Oxford Real Estate Insights and our podcast on real estate research and practice, the Property Pod.
Great to be here.
Today we're diving into a really fascinating piece of research. It looks at a connection you might not immediately think of, how the roof over your head, your home, can actually influence whether you decide to, chase those entrepreneurial dreams.
That's right. It's a great paper we're unpacking today. It's called Housing, Collateral and Entrepreneurship.
Okay.
Published back in 2015, and it was in a top journal, the Journal of Finance.
Right. And the authors, we should mention them.
Yeah, definitely. It was Martin C. Schmalz, who was at the University of Michigan's Ross School of Business then.
Okay.
David A. Sraer from UC Berkeley, and David Thesmar from HEC Paris, and also CEPR.
A strong lineup. So what this research gets into, fundamentally, it's this link between your home's value and starting a business, right? And even how it grows.
Exactly. It's about how the value of your home, specifically as collateral, can affect, well, first, whether you even start a business, and second, maybe how big it gets or how fast it grows.
And why is that important to dig into?
Well, it helps us see the housing market's impact beyond just, buying and selling houses. It really touches on a fundamental question. What actually helps new businesses get off the ground? What enables entrepreneurship?
So the big question these researchers were tackling, was it basically about money? Like, do financial constraints, specifically not having assets for collateral, stop people starting businesses?
Pretty much, yeah. Do those constraints prevent people from starting, or maybe just limit how much they can grow once they do start?
And how did they even approach that? It sounds complicated.
They used a really clever approach, actually. They focused on France and specifically on how house prices changed across different regions there.
Ah, France. Now, the French context is pretty key here, isn't it? Why France?
Absolutely crucial. France has, or at least had then, a somewhat, let's say, underdeveloped mortgage market compared to places like the US or UK.
Okay.
And importantly for the study, things like home equity withdrawal or taking out second mortgages were really rare. Very difficult to do.
I see. So unlike here, maybe, where you might remortgage to get cash.
Exactly. That wasn't really a common option there. So this meant that really only people who own their homes outright, no mortgage left, could easily use their house as collateral for something like a business loan.
Okay, so that unique situation, it's kind of created a natural experiment.
Sort of, yeah. It allowed the researchers to really isolate the effect of housing as collateral, separating it from just general wealth. It was like a cleaner test case.
Smart. So what data did they actually use to test this?
They pulled together some really good data. First, to see who starts a business, what they call the extensive margin, they used the French labor force survey. This was from 1992 to 2002. It's great because it tracks the same people over 3 years, so you see changes. And it had info on home ownership, where they lived, job choices, all the key stuff.
Right. And then what about after the businesses started, the intensive margin, how it grows?
Yeah, for that bit, they used a different survey. This one was focused on French entrepreneurs who actually registered a business in one specific year, 1998.
Ah, a cohort.
Exactly. And they combined that survey data with firm-level accounting data from tax files. So they got the hard numbers, assets, sales, employees for up to 8 years.
Wow. Okay. So they could really see the journey.
Yeah, a pretty detailed picture over time.
So they have the French context, they have the data. How did they actually connect the dots? How did they use this to see if house prices mattered?
The core idea, the main comparison, was between homeowners and renters within the same region.
Okay. Why that comparison?
Well, the thinking is, imagine house prices go up in a particular town. The homeowners there suddenly have potentially more collateral, right? Their house is worth more. But the renters in that same town face similar local economic conditions, job market, local demand, whatever, but they don't get that collateral boost.
I get it. So you're comparing people facing similar local vibes, but one group gets this potential financial advantage from housing.
Precisely. It helps control for those local economic factors. But they didn't stop there. They went a step further to really zero in on the collateral effect.
How?
They split the homeowners into two groups, those who owned their home outright, full owners, they called them.
No mortgage.
Right. And those who still had a mortgage, the partial owners.
And going back to that French system,
yeah,
only the full owners could easily use the house for a loan. Yeah.
Exactly. So the researchers made a prediction. If this is really about collateral, then rising house prices should boost entrepreneurship mainly for those full owners, not so much for the partial owners, or at least less so.
Right. Is that what they found?
That's precisely what the data showed. It lined up perfectly with the collateral story.
Okay, this is where it gets really interesting. Lay out the findings for us. What difference did rising house prices make?
Okay, so the headline finding. A clear, significant link. Homeowners in regions where house prices had gone up more were more likely to start businesses compared to renters in those exact same regions.
More likely. Was it a big difference?
It was pretty substantial, yeah. And digging deeper, the effect was even stronger for those full owners, the ones without the mortgage.
Right, the ones who could actually tap the equity.
Exactly. And interestingly, also stronger for poorer homeowners, but ones who owned larger houses.
Why that combination? Poorer but larger house.
Well, think about it. If you don't have many other assets, but you fully own a decent-sized house that's gone up in value, that increase in potential collateral is a much bigger deal for you, relatively speaking.
That makes sense. It's a bigger slice of their potential funding pie.
You got it. Quantitatively, they estimated that going from, say, the bottom quarter of house price growth to the top quarter increased the probability of a full owner starting a firm relative to a renter by about 11%.
11%. Just from house price changes. That's quite something.
It really is. It shows how much that locked-up home equity matters, potentially.
Okay, so that's about the decision to start. What about the businesses themselves? Did the house price effect show up in how well they did or how big they were?
Yes, it did. They looked at that 1998 cohort of entrepreneurs again, and they found that businesses started by homeowners in areas with higher past house price growth. Well, they were bigger right from the get-go. More assets, higher sales, more employees at creation.
So it's not just more businesses, but potentially stronger businesses from day one.
Seems like it. These treated firms, as they called them, started by homeowners benefiting from price rises, also used more debt, interestingly.
Suggesting they could access more funding.
Plausibly, yeah. And they generated more value overall. And crucially, this wasn't just a launch effect. These differences persisted.
How long for?
For years. The study found that firms started by entrepreneurs who had less initial collateral, like renters or homeowners in low-growth areas, tended to remain smaller in the long run.
Wow. So those initial funding conditions, potentially linked back to housing wealth, can cast a long shadow.
It really suggests that. Access to capital early on, maybe facilitated by home equity, seems pretty critical for the long-term trajectory.
Did they look beyond individual firms? Like the whole region?
They did. They looked at aggregate regional data, too, and they found that the total amount of firm creation in a region was more strongly linked to house prices in regions that had a higher percentage of homeowners overall.
Okay, so it scales up. It's not just isolated individuals. It affects the regional dynamic.
Yeah, it suggests the individual collateral effect adds up to something noticeable at the regional level. More homeowners means house price changes potentially have a bigger impact on overall entrepreneurship there.
Now, any good study has to consider other explanations. I mean, could rising house prices just make homeowners feel richer, more optimistic, and that's why they start businesses? A wealth effect, not a collateral effect.
Absolutely. A key question. They definitely considered that, the wealth effect argument. Or maybe, as house prices rise, rents go up too, which makes life harder for renters, pushing them away from entrepreneurship, making homeowners look better by comparison.
Right, other possibilities. How do they rule those out?
That comparison between the full owners and partial owners was really powerful here.
Because both groups would feel wealthier if prices went up.
Exactly. Both would experience that general wealth effect, but only the full owners got the significant collateral benefit in the French system. So when the data showed the stronger effect was specifically tied to the full owners.
It pointed much more clearly towards collateral being the driving force.
Precisely. And regarding the rent issue, they noted that rents in France were actually quite stable during the period they studied. So it wasn't likely that renters were being significantly squeezed by rising rents in a way that explained the findings.
So the specific features of the French market really helped them nail this down.
It really did. It provided that cleaner separation. They also did other checks, looking at things like risk aversion, other unobserved factors. But the housing collateral channel consistently came out as the most convincing explanation for their results.
Did they find the effect was stronger in certain situations, like for certain types of businesses or people?
Yes, and this also supports the collateral story. They found the impact of housing collateral was bigger in industries where credit constraints are typically tighter.
Makes sense. If bank loans are hard to get anyway,
Hmm.
home equity becomes even more valuable.
Right. And they also saw a stronger effect for people who were previously unemployed before starting their business.
Why them specifically?
Well, someone who's been unemployed might face extra hurdles getting traditional finance. So having that housing collateral could be particularly crucial for them to overcome those barriers and get their venture started.
Okay, so pulling this all together, what's the big takeaway for us, for listeners thinking about property and business?
I think the main takeaway is this really powerful, maybe often overlooked link between the housing market and the entrepreneurial ecosystem.
Yeah.
It shows that the value tied up in our homes isn't just, wealth on paper. It can be an active ingredient, a potential key that unlocks new businesses, especially where other funding is scarce.
The French context was unique, as we said, but does the basic idea apply elsewhere?
I think the underlying principle likely has broader relevance.
Hmm.
The idea that tangible assets, like a house, can help overcome borrowing constraints and enable entrepreneurship, that feels pretty universal, even if the mechanisms differ in places with easier home equity access.
So it makes you think about housing market ups and downs, not just in terms of affordability, but also maybe in terms of innovation, job creation.
Exactly. Housing market dynamics can ripple through the economy in ways we don't always consider, potentially influencing the rate at which new ideas and new jobs emerge.
It definitely raises some big questions, doesn't it? It's like, how does this play out in, say, the US or UK market today, where ELOCs and remortgaging are common? Does it change the dynamic?
A great question. Does easier access make the link stronger or maybe weaker because there are other credit channels? And what about policy? If home equity is important, are there implications for supporting entrepreneurship, especially for homeowners?
Things like loan guarantee programs, maybe? Or support specifically targeted at those with home equity?
Potentially. It suggests policymakers might want to consider the interaction between housing policy and entrepreneurial support. These aren't totally separate worlds.
Definitely food for thought. We hope this encourages you, the listener, to think a bit differently about housing wealth and its potential roles.
Absolutely. Thanks for tuning in for this deep dive into housing collateral and entrepreneurship. We hope you found it insightful.
Indeed. Please join us again next time on The Property Pod, where we'll unpack another fascinating piece of real estate research and practice.